understandably, the greatest concentration when thinking about intergenerational tax planning is on reducing, avoiding, minimizing inheritance tax. Obviously, I've talked in other videos about the importance ahead of that of having a tax efficient accumulation and a tax efficient decumulation to build up and then preserve as much wealth as possible. But of course, minimizing inheritance tax is really, really important. For most couples, the inheritance tax liability will arise on the death of the second of them to die. We all know that. Most couples leave most of their wealth to the survivor. And whether the couple is a married couple or civil partners, then that first transfer will be, of course, free of inheritance tax. So I'm not now going to bore you to death, as I usually do, with a complete rehash of how inheritance tax works. But let's work on the premise that for most people, inheritance tax will be a second death issue. And of course, the key principle of inheritance tax plan, from a pure taxation standpoint, is the less you have in your estate on death, or to the extent you have stuff in your estate, it qualifies for relief from inheritance tax, the better the inheritance tax outcome will be. Okay, yeah, we accept that, but for a lot of people, that might not be possible because, surprise, surprise, they like to have assets while they're alive and to have access to some assets, both the assets themselves or the feeling of just having assets, and it makes them feel better to just have that access and not be down to the last penny. So for many, lifetime giving, which of course should definitely be considered because that is what contributes towards having less available to be subject to inheritance tax on death, is difficult. Why is that? Because of that need to have potentially access to the assets, or maybe just because the need to have control over the assets. Are you making that gift and then going, oh, I wish I hadn't given it to them sometime later? Access and control can both be overcome with trusts and the other structures that are available to us in the financial services sector. Another thing to take into account, however, just before getting on to what are the sort of solutions that we have available, is of course, where the asset that you're thinking about transferring is an asset that is a chargeable asset for capital gains tax. It seems mad to me every time I think about this, but when you make a gift of such an asset probably to someone who's close to you in your family, that will be treated as a disposal at full market value for capital gains tax purposes. So it's as if you sold it. And so that could give rise to a CGT liability. On the other hand, to the extent you hold assets chargeable to CGT on death, all the CGT is wiped out on death. It's the best form of capital gains tax planning you can do, that is to die. However, most people tend not to plan on that basis. So when it comes to lifetime planning, yeah, I'd like to consider it, but I need to have access and control. Then we think about the solutions that the financial sector has that overcome, legitimately, perfectly and proven, that overcome the gift with reservations and pre-owned assets tax provisions. That is basically the gift. Those provisions say the gift isn't effective for inheritance tax, even though it's legally effective, if you retain access to the assets at any time. So if you retain an enjoyment, the ability to enjoy the assets or the income from those assets or the use of those assets. So the use of an appropriate trust with appropriate financial products allow you to overcome that. Loan trusts, obviously, discounted gift trusts, obviously, and variations on those themes. And both of those plans, loan trusts and discounted gift trusts, are not required to be disclosed under the DOTAS provisions, disclosure of tax avoidance schemes provisions. Loan trusts, because they're not seen as avoidance schemes explicitly, and DGT schemes are not seen as such assets because they are excluded, provided they were of a type, that is, the scheme was of a type that was available in the market before April, I think, 2018. So basically, most DGTs available now and all loan trusts won't have to be disclosed under DOTAS. Just a small point, but nevertheless an important one. And let's not forget, we could spend a lot more time speaking about inheritance tax. Let's not forget the power of protection, life insurance, to provide for the liability to inheritance tax to the extent it can't be reduced, which for many it won't be. And also, of course, perhaps even to enhance or create a legacy just at the time you would like to leave it, i.e. on your death. So the combination of those things, trusts, appropriate products, life insurance protection, and of course, pension arrangements which are completely free of inheritance tax. And let's not forget, of course, investing in assets that qualify for business relief, which will allow you to have inheritance tax efficiency after 2 years of ownership, and importantly, complete ownership and control, all to be considered. No one thing will be a solution for most. It will be a combined approach that will work best for each individual, and each individual's plan will depend on what's important to them. So the importance of the advisor in that process is absolutely critical, to know the client and what's important to them, and then to know what's available and what works in the market.